Welcome to the deep dive. Today, we're really focusing on the core of economics, those fundamental questions.
Exactly, the ones that really help us understand how economies actually work.
We want to give you the essential building blocks, the foundations that influence everything, really, from your morning coffee right up to global trade.
Right. And we've pulled together a set of, well, really crucial economic questions. Our plan isn't just to list definitions.
No, definitely not.
We want to explore the answer to each question, get to the heart of it, so you get a clearer picture of these economic forces in action.
And we are covering quite a bit, aren't we? From like the basics of production all the way to international markets and how they're structured.
It's a broad sweep, yeah. The aim is to give you a solid grasp of these key ideas and, crucially, their answers.
Okay, let's dive right in then. First question, what are the factors of production?
Right. So this question is asking about the fundamental ingredients, you could say, needed to make anything, goods or services.
Oh.
Traditionally, economists group them into four main types. First up is land.
Land, like actual ground.
Well, yes, but it's broader. Think of it as all natural resources, minerals, water, forests, the air we breathe. The free gifts of nature, as economists sometimes say.
Ah, okay. So if you're farming, it's the field, but also the rain, the soil quality, all that natural stuff.
That's land. The second factor is labor.
Right. People working.
Yes, the human effort involved.
Yeah.
That can be physical work like building something, or mental effort like designing software or managing a team. It's the human input.
Skills, time, effort.
That's labor.
Okay. Then number three is capital. And that's not just money, is it?
That's a common confusion, but no. In economics, capital means the produced means of production. So tools, machinery, factory buildings, computers.
The stuff we use to make other stuff.
Exactly. It's equipment, infrastructure, things that have been produced already to help us produce more efficiently in the future, like a baker's oven or a programmer's computer.
Got it. So land, labor, capital. What's the fourth one?
The fourth is entrepreneurship. This is the human element that brings the other three factors together.
The driving force.
Kind of, yeah. It involves taking initiative, innovating, organizing production, and, crucially, taking on the risks associated with the business venture. It's about spotting an opportunity and making it happen.
Okay, let's bring this down to earth. Say someone opens a bakery.
The example.
The land is the shop location, maybe the water used. The labor is the bakers, the cashier. The capital is the ovens, mixers, display cases.
Right.
And the entrepreneur is the owner who had the idea, got the loan, hired the staff, decided what bread to bake. They're the one pulling it all together and taking the risk.
You've nailed it. Each factor plays a distinct, vital role. Okay, shall we move to the next question?
Let's do it. Question 2. Describe opportunity cost. This one sounds important.
Oh, it's incredibly important, and actually quite intuitive once you grasp it.
So what's the answer?
Simply put, opportunity cost is the value of the next best alternative you give up when you make a choice.
The next best thing you could have done.
Exactly. Because resources, time, money, materials are limited. Choosing one thing means you can't choose something else. The opportunity cost is the value of that foregone alternative.
The source uses a farmer example, right? Wheat versus rice or something.
Yes, corn versus soybeans in the version I saw, but the principle's the same. Imagine a farmer has a field. They can plant corn or soybeans, if they choose corn.
Then the opportunity cost is the soybeans they didn't grow.
Precisely. It's the potential profit or benefit they missed out on by not planting soybeans. That's the opportunity cost of the corn.
So it's not just about the money spent on corn seeds, but the potential income lost from the alternative.
Right. And thinking about opportunity cost helps us make more efficient decisions. Businesses do it,
Yeah.
governments do it, and we all do it in our daily lives, even if we don't use the term. It forces you to weigh the trade-offs.
Makes sense. Allocate resources better by knowing what you're sacrificing. Okay, next up, define marginal utility, or MU.
Marginal utility.
Right.
This concept is about satisfaction or utility you get from consumption. Specifically, MU is the additional satisfaction or benefit you get from consuming one more unit of a good or service. It's the utility from that very last unit.
So if I eat one cookie, then a second, the marginal utility is the extra enjoyment just from that second cookie.
Exactly. Not the total enjoyment, just the increase you got from adding that second one. The formula captures this. MU is the change in total utility when you consume one more unit. TUN minus TUN1.
Can you give a quick example?
Sure. Think about drinking water when you're really thirsty. That first glass, Huge satisfaction rate, high marginal utility.
Definitely.
The second glass, still good, but maybe not quite as satisfying as the first. The marginal utility is likely lower.
Yeah, I can see that.
By the third or fourth glass, the additional satisfaction from each extra glass probably gets smaller and smaller. You might even reach a point where another glass gives you zero additional utility, or even makes you feel uncomfortable negative marginal utility.
The law of diminishing marginal utility. Got it. Okay, let's shift to markets. Next question. What are the features of perfect competition? Sounds perfect.
Huh. Well, it's a theoretical benchmark, really, not something you often see in its pure form.
Okay, so what defines this theoretical market?
Perfect competition assumes, first, a very large number of buyers and sellers, so many that no single one can influence the market price.
Lots of small players.
Right. Second, they're all dealing in a homogeneous product, identical goods or services. Think, maybe, certain agricultural commodities, like a specific grade of wheat. One farmer's output is essentially indistinguishable from another's.
Okay, identical products, many players. What else?
Third, there's freedom of entry and exit. Businesses can easily start up or shut down in this market without major barriers.
Easy come, easy go.
Fourth, perfect knowledge. Everyone, buyers and sellers, knows all the relevant information, especially about prices. No secrets.
Full transparency.
Fifth, perfect mobility of factors and goods. Resources like labor and capital can move freely to where they're needed, and goods can be transported easily. And finally, often assumed is the absence of transport costs, just to simplify the model.
Wow, that is a strict set of conditions. Very theoretical, as you said.
Exactly. But it's a useful model. It helps economists understand the forces of supply and demand in their purest form and provides a baseline for comparing real-world markets, which are usually less than perfect.
Right, which leads nicely to our next question. Define market structure. Perfect competition is one type, so what's the overall concept?
Market structure is basically how we classify different markets based on their competitive characteristics.
How much competition there is.
That's the main thing, yes.
Yeah.
It looks at things like how many firms are there? Are the products identical or differentiated? How easy is it for new firms to enter the market?
And the source mentioned four main types.
That's right. We've covered perfect competition. Then there's monopoly, just one seller. Monopolistic competition, many sellers, but with slightly different products, like restaurants or hairdressers. And oligopoly, only a few large firms dominate, like in the mobile phone industry or airlines.
So the structure shapes how firms behave their pricing, output, advertising.
Absolutely. The degree of competition fundamentally influences market outcomes.
Okay, let's zoom out again to the whole economy. Question 6. Differentiate between GDP and GNP. These always trip people up.
They do, but the difference is key. Let's start with GDP, gross domestic product.
Domestic, so inside the country.
Exactly. GDP measures the total value of all final goods and services produced within the geographical boundaries of a country in a given period, usually a year. It doesn't matter who owns the production facilities. If it's made here, it counts towards our GDP. It excludes net factor income from abroad.
Okay, so a car made in a UK factory owned by a German company counts towards UK GDP.
Correct. Now, GNP, gross national product.
Awesome. So about the people.
Yes, about the country's nationals or residents. GNP measures the total value of final goods and services produced by the labor and capital owned by a country's residents, regardless of where that production happens. It includes net factor income from abroad.
So in that car factory example, the profit sent back to Germany would count towards Germany's GNP, not the UK's GNP.
Precisely. And the value of the cars made in the UK factory counts towards UK GDP. But the profit part going to Germany counts towards German GNP.
Okay, I think I've got it. GDP echolocation. GNP is out ownership nationality.
That's a great shorthand way to remember it. GDP is about where it's produced. GNP is about who produces it.
Excellent. Moving into finance now. Question 7. What is money market and its functions?
Okay, the money market. This is the part of the financial system that deals with short-term borrowing and lending.
Short term? How short?
Generally, we're talking about financial instruments with a maturity of 1 year or less. Think treasury bills, commercial paper, certificates of deposit.
And why does it exist? What's its main purpose?
Its core objective is managing liquidity, ensuring that businesses, banks, and even governments have access to funds for their short-term needs. It's typically seen as low risk compared to, say, the stock market.
Okay, facilitating short-term cash flow. What are its main functions according to the source?
Well, several key roles. First, financing trade, providing the short-term credit businesses need for buying and selling. Second, it helps the central bank implement monetary policy. They often operate in the money market, to influence interest rates.
Right, open market operation, things like that.
Exactly. Third, it supports industry by providing working capital. Fourth, it helps commercial banks manage their own liquidity, lending surplus funds, or borrowing when short. And fifth, it generally helps funds move efficiently through the financial system, financial mobility.
Sounds like essential plumbing for the financial system. Okay, back to the international scene. Question 8. What do you mean by BOP?
BOP stands for Balance of Payments. It's essentially a country's bookkeeping system for all its economic transactions with the rest of the world over a period, usually a year.
All transactions. Imports, exports. What else?
Everything. Trade in goods and services, financial flows like investments and loans, tourism spending, foreign aid, remittances. It's a comprehensive record.
And why keep such detailed records? What's the point?
The main purpose is for the government. It shows the country's international financial position. Are we earning more foreign currency than we're spending, or vice versa? This helps in formulating economic policy, managing exchange rates, that sort of thing.
So it's a diagnostic tool for policymakers. Is it useful for anyone else?
Oh, yes. Banks, firms involved in international trade, investors, they all use BOP data to understand risks and opportunities in the global economy.
Makes sense. And what are the main sections, the major components of this BOP record?
The source lists 4 key components. There's the current account, which covers trade in goods, visibles, and services, invisibles, plus income flows and transfers.
Okay, trade and income.
Then the capital account, dealing with capital transfers and acquisition disposal of non-financial assets. Often paired nowadays with the financial account, which covers investment flows, direct investment, portfolio investment, loans.
Investments and assets.
Third, the unilateral payments account, which captures one-way transfers like foreign aid or gifts where nothing is expected in return.
Okay.
And fourth, the official reserves account. This tracks changes in the country's holdings of foreign currency, gold, and other reserve assets held by the central bank.
Got it. A full picture of international dealings. Staying international. Question 9 asks, what is free trade and its advantages? A big topic.
Huge and often controversial, but the basic definition is simple.
Which is?
Free trade is a policy where governments don't put restrictions on imports or exports. No tariffs, no quotas, no artificial barriers. It's the free market idea applied to international trade.
Okay, an open borders approach to goods and services. What are the arguments for it? What are the supposed advantages?
Proponents highlight several key benefits. First, better resource allocation globally. Countries can specialize in producing what they're best at comparative advantage, leading to greater overall efficiency.
Makes sense. Focus on strength.
Second, linked to that, is potential for large-scale production and division of labor, further boosting efficiency and maybe lowering costs. Third, increased competition. Imports keep domestic firms on their toes, potentially weeding out inefficient ones and driving innovation.
More choice and potentially lower prices for consumers too.
That's the fourth point, yes. Access to goods from around the world often means more variety and lower prices. Fifth, it can prevent domestic monopolies from forming or becoming too powerful. And finally, it's often argued that free trade promotes economic growth overall.
Those sound like strong arguments. Okay, let's pivot back to basics. Question 10. What are the basic economic problems?
Ah, yes. This goes right back to the fundamental issue in economics.
Which is scarcity, right?
Yeah. Exactly. The core problem is that human wants are essentially unlimited, but the resources we have to satisfy those wants, land, labor, capital, are limited. They're scarce.
We want more than we can have.
Pretty much. And adding to the problem is that these scarce resources have alternative uses. That piece of land could be a farm, or a factory, or a park. That person's time could be spent doing job A or job B.
So unlimited wants, limited resources, and choices about how to use those resources. That's the root of it.
That's the trifecta. And it forces every society, every economy, to answer 3 fundamental questions.
Okay, what are they?
First, what to produce and how much? Which goods and services should we make? More cars or more buses, more food or more entertainment? And in what quantities?
The allocation question, what's second?
Second, how to produce. What methods should we use? More machines and fewer workers, capital intensive. Or more workers and fewer machines, labor intensive. This often depends on what resources are abundant and cheap.
The production method question. And third?
Third, for whom to produce. Once the goods and services are made, who gets them? How is the national pie divided up? Is it based on income? On need? On status? This is the distribution question.
What, how, and for whom? Every economy has to figure that out. Okay, next. Explain PPC, Production Possibility Curve. Sounds like a graph.
It is. The PPC is a graphical tool economists use to illustrate those very problems we just discussed: scarcity, choice, opportunity cost.
How does it do that?
It shows the various combinations of two goods, let's say, guns and butter, the classic example that an economy can produce if it uses all its resources fully and efficiently, given its current technology.
So it shows the maximum possible output combination.
Exactly. The curve itself represents the production frontier. Points inside the curve are achievable but inefficient. Points on the curve are efficient. Points outside the curve are unattainable with current resources and tech.
And it shows trade-offs.
Yes, because it slopes downwards. To produce more of one good, say guns, you have to produce less of the other, butter. The amount of butter you give up to get more guns represents the opportunity cost. It visualizes scarcity, choice, and cost all in one diagram.
Very neat. Okay, sticking with production. Explain expansion path.
The expansion path relates to a firm's production decisions in the long run,
Long run, meaning?
meaning a period where the firm can change all its inputs, can build a bigger factory, hire more workers, buy more machines.
Okay, so what does the expansion path show?
It shows the cost-minimizing combination of inputs, say, labor and capital for each possible level of output, assuming input prices stay the same. As the firm decides to produce more, expand, the path traces out the most efficient way to combine inputs to achieve that higher output level.
So it's like a roadmap for efficient growth.
That's a good way to think about it. Technically, it connects the tangency points between the firm's isoquants, curves showing input combos for a given output, and its isocost lines, lines showing input combos for a given cost. Where they touch is the least cost way to produce.
Got it. Moving to business finance, what is MOS? What happens when MOS is low?
MOS stands for margin of safety. It's a measure of how much cushion a business has between its current sales level and its break-even point.
The break-even point being where costs equal revenue.
Exactly. So MOS is calculated as actual sales minus break-even sales. It tells you how much your sales could drop before you start making a loss.
Sounds like a vital sign for a business. So what does it mean if it's low?
A low MOS is generally not good. It means the company is operating very close to its break-even point.
Not much room for error.
Right. Any small decrease in sales, maybe due to increased competition or an economic downturn, could push the company into the red. It indicates a higher level of risk.
Okay, higher MOS is better, provides more buffer. Now, back to market structures. What is collusive oligopoly?
Right. Oligopoly, that's the market with just a few dominant firms. Think airlines, mobile networks.
Where they really watch each other closely.
Intensely. Because there are so few firms, they're interdependent. One firm's price cut can trigger responses from all the others, potentially leading to price wars that hurt everyone's profits.
So they try to avoid that.
Sometimes, yes. Collusive oligopoly is when these firms, instead of competing fiercely, coordinate their actions. They might secretly or informally agree on prices to charge, output levels to produce, or markets to serve.
Acting like a monopoly, but with multiple players agreeing.
Essentially, yes. They form a cartel, explicit or tacit, to restrict competition, raise prices, and increase their joint profits. Of course, this kind of collusion is often illegal under antitrust laws.
And probably hard to maintain, since someone always wants to cheat.
That's the inherent instability, exactly.
Yeah.
But the incentive to collude is there.
Interesting. Okay, different topic. Pricing strategies. What is price skimming?
Price skimming is a strategy often used when launching a new, innovative product.
Like a new smartphone or gadget?
Often, yes. The idea is to start with a very high price. You target the early adopters, the consumers who are really eager to have the latest thing and are willing to pay a premium for it, maybe for the status or the features.
Give them the cream off the top.
Exactly. You capture the maximum revenue from those least sensitive to price first. Then over time, as the initial hype fades, competition perhaps emerges, or you want to reach a broader market.
You lower the price.
Correct. You gradually reduce the price in stages to attract more price-sensitive customer segments. The source mentions status symbol commodities as a good example.
Makes sense. Start high, then go lower to capture different market segments. Now back to GDP. How is GDP calculated? We know what it is, but how do they get the number?
Right. Well, fundamentally, it's about adding up the monetary value of all final goods and services produced domestically in a year.
Final goods. Why final?
To avoid double counting. If you count the value of the flour sold to the baker and the value of the bread the baker sells, you've counted the flour twice. So GDP only includes the value of the final product, the bread sold to the consumer.
Okay, only final goods and services. And domestically produced.
Yes, within the country's borders. And remember, it excludes net factor income from abroad, That's the GNP distinction we made earlier. There are different approaches to the calculation. The production approach, value added, the income approach, adding up incomes, and the expenditure approach, adding up spending. But they should theoretically all arrive at the same number.
Okay, summing up the value of final domestic production. Now, we mentioned money markets. Question 17. Difference between money market and capital market.
Right, the two main segments of the financial market. The key difference is the time frame, the maturity of the instruments traded.
Money market is short term, we said.
Yes, instruments maturing in 1 year or less. Its main objective is liquidity, meeting short-term cash needs. Think treasury bills, commercial paper.
And the capital market.
That's for long-term funds. Deals with stocks, which have no maturity, and bonds and loans with maturities longer than 1 year. Its purpose is to finance long-term investments, like building factories or infrastructure.
So, short-term liquidity versus long-term investment funding. Are the players different too?
Often, yes. The source lists examples. Money markets heavily involve central banks, commercial banks, and large corporations managing cash flow. Capital markets involve stock exchanges, investment banks, pension funds, insurance companies, individual investors buying stocks and bonds for the long haul.
Different needs, different instruments, different players. Clear. Next question. What is devaluation? Sounds like something to do with currency value.
It is. Devaluation is a deliberate act by a government or central bank to reduce the official value of its currency against other currencies. This usually happens in countries with a fixed or managed exchange rate system.
So they intentionally make their money worth less internationally. Why?
The main goal is usually to tackle a balance of payments deficit. By making the domestic currency cheaper, it makes the country's exports cheaper for foreigners to buy.
Boosting export demand.
Right. And simultaneously, it makes imports more expensive for domestic residents.
Reducing import demand.
Exactly. So the hope is that devaluation will improve the trade balance and ease the pressure on the balance of payments.
A policy tool to influence trade flows. Okay, next question. What do you mean by shutdown point? This sounds quite drastic for a firm.
It is a critical point, yes. The shutdown point is the level of price and output, below which a firm is better off temporarily ceasing production altogether rather than continuing to operate.
Better to just stop? When does that happen?
It happens when the market price for the product falls so low that it doesn't even cover the firm's average variable costs, AVC, the costs that change with output, like raw materials and direct labor.
So they're losing money on every single unit they produce, even before considering fixed costs like rent.
Precisely. At that point, by producing, they're losing their fixed costs,
Right.
plus some variable costs. If they shut down temporarily, they still have to pay their fixed costs, but they avoid losing money on the variable costs too. So minimizing losses means shutting down, typically where price equals minimum AVC.
A tough decision, but financially rational at that point.
Mm.
Okay, next. What is predatory pricing? Sounds aggressive.
It is. Predatory pricing is when a dominant firm deliberately sets its prices extremely low, often below its own costs for a period of time.
Why would they do that? They'd lose money.
In the short term, yes, but the goal is anti-competitive. They aim to drive existing competitors out of the market because the competitors can't sustain such low prices. It also deters potential new entrants.
Eliminate the competition.
And then once the competition is gone, the predatory firm can raise its prices significantly, potentially to monopoly levels, and recoup all its earlier losses and earn large profits in the future. It's generally considered harmful to consumers and is illegal in many places.
A risky and often illegal strategy to gain market power. Okay, back to oligopoly. What do you mean by non-price competition under oligopoly?
Right, so in oligopolies, those markets with a few big firms, direct price competition can be really damaging, leading to price wars.
We mentioned that, so they compete in other ways.
Exactly. Non-price competition involves trying to attract customers and gain market share using methods other than lowering prices. It's about differentiating your offering in other ways.
Like what? What are the examples?
The source gives good ones. Advertising and branding campaigns are huge, offering better quality products or services, providing excellent customer service or after-sales support, loyalty programs like supermarket points cards, free gifts or bundled offers, subsidized delivery from online retailers. Basically anything that makes your product more attractive without cutting the price tag.
Competing on quality, service, convenience, brand image.
All of that, yes. Trying to build customer loyalty and perceived value.
Makes sense. Let's look at economic sectors now. Question 22. What are the important activities under primary sector?
The primary sector is all about activities that directly involve extracting or harvesting natural resources from the earth.
The raw materials end of the economy.
Exactly. It's the foundation. The main activities listed are agriculture, farming crops, raising animals, animal husbandry, poultry farming, also forestry, managing and harvesting timber, fishing,
Yeah.
and mining and quarrying, extracting minerals, metals, coal, oil, stone, etc.
So farming, fishing, forestry, mining. Got it. Next, a financial distinction. Difference between bonds and share.
Okay, both are ways for organizations to raise money, but they represent fundamentally different things for the investor. A bond is debt.
You're lending money.
Correct. You lend money to the issuer, a company or government. They promise to pay you back the principal amount at a future date, maturity, and usually make fixed interest payments, coupons, along the way. You're a creditor.
So a fixed return, relatively predictable, assuming the issuer doesn't default. What about a share?
A share, or stock, represents ownership or equity in a company. When you buy a share, you become a part owner.
An owner, not a lender.
Right. You're entitled to a share of the company's profits, usually paid out as dividends, but these aren't guaranteed. They depend on the company doing well. You might also benefit if the share price goes up, reflecting the company's growth prospects. There's no maturity date. You get your money back by selling the share to someone else.
So potential for higher returns, but also higher risk and less certainty than bonds.
Generally speaking, yes. Bonds are debt, shares are equity, different risks, different potential rewards.
Clear difference. Now, back to the balance of payments. Question 24. What are the major components of BOP, balance of payments? We listed them briefly. Can we recap?
Sure. The BOP tracks all economic transactions with the rest of the world. The main components are, first, the current account.
Trade and income flows.
Right. Exports and imports of goods, merchandise and services and visibles, plus income earned on foreign investments and transfers like remittances.
Okay.
Second, the capital account, in a narrow sense, and the financial account, which is broader and often includes the capital account now. This covers flows related to investment.
Buying assets abroad, foreigners buying assets here.
Exactly. Foreign direct investment, buying companies, portfolio investment, buying stocks, bonds, loans, etc.
Third,
Unilateral payments. Those one-way transfers like foreign aid or gifts.
got it. And fourth?
Fourth, the change in official reserves. How much foreign currency, gold, etc. the central bank gained or lost. These components should all balance out in the end.
A comprehensive picture. Okay, trade policy again. Question 25. What are the arguments in favor of protection? We did free trade's advantages, now the other side.
Right. Protectionism involves using barriers like tariffs or quotas to shield domestic industries from foreign competition. Why might a country do that?
What are the arguments?
Well, one classic argument is the infant industry case.
Yeah.
The idea is that new developing industries in a country might need temporary protection from established foreign competitors to give them time to grow, learn, and become efficient enough to compete on their own.
Shielding them while they get started. What else?
National security is another common argument. Countries might want to protect industries considered vital for defense or self-sufficiency, like weapons manufacturing or even food production, so they aren't reliant on foreign suppliers in a crisis.
Makes sense in certain contexts.
Protecting domestic jobs is another major argument, although economists often debate its effectiveness and costs. The idea is that restricting imports protects jobs in domestic industries that would otherwise face tough foreign competition. There are others too, like preventing dumping, selling below cost by foreign firms, or raising revenue for the government from tariffs.
So infant industries, national security, jobs, these are the typical rationales put forward. Important to note, as you said, these are arguments for, and they often have downsides too.
Absolutely. Protectionism is a complex issue with trade-offs.
Okay. Next, the big picture again. What is the significance of national income calculation? Why bother calculating GDP, GMP, etc.?
Calculating national income, the total income generated in an economy from production, wages, profits, rent, interest, is incredibly significant. Firstly, it's the primary way we measure a country's overall economic performance. Is the economy growing, shrinking, how fast? National income figures tell us that.
A barometer of economic health.
Exactly. Secondly, governments rely heavily on this data to formulate economic policies. Tax policies, spending decisions, monetary policy, they're all informed by national income trends.
Guiding policy. What else?
Thirdly, it allows for international comparisons. We can compare the economic output and, roughly, the standard of living between different countries, though adjustments for population and prices are needed. Fourthly, it helps us understand the structure of the economy. How much does manufacturing contribute versus services versus agriculture? This shows where growth is coming from, or where problems might lie.
So performance tracking, policy guidance, international comparison, and structural analysis. Very important stuff. Okay, back to the firm level. What do you mean by producer equilibrium?
Producer equilibrium is about efficiency for the firm. It's the point where the producer is doing the best they can with their resources.
Best in what sense?
It can be looked at in two ways, which lead to the same point. Either the producer is achieving the maximum possible output for a given level of cost, or they are producing a specific target level of output at the minimum possible cost.
Maximum output for cost or minimum cost for output, the sweet spot.
Precisely. It represents the most efficient combination of inputs, like labor and capital, for the firm. The source notes this occurs graphically, where the isoquant curve is tangent to the isocost line.
Where the what you can produce curve just touches the what you can afford line?
That's the idea, least cost combination for that output level.
Got it. Next, a very basic one. What is the relation between price and demand?
This is fundamental. Demand refers to how much of a good or service consumers are willing and able to buy at a specific price over a specific time period.
Willing and able.
Yes, both are important.
Uh-huh.
And the relationship with price, it's typically inverse, meaning all else being equal. When the price of a good goes up, the quantity demanded generally goes down. And when the price goes down, the quantity demanded generally goes up. It's the law of demand. Price is a key factor influencing how much people want to buy.
Higher price, less demand. Lower price, more demand. Simple enough. Next. Why does the problem of choice arise? We keep coming back to this.
Because it's the fundamental economic problem. Choice arises directly from scarcity.
Unlimited wants, limited resources.
Exactly. Because we can't have everything we want, scarcity of resources, we must choose. And because those limited resources have alternative uses, that land could be a park or a factory or grow vegetables, the choice becomes meaningful. Choosing one use means giving up the others.
So scarcity forces choice, and alternative uses make the choice have consequences, opportunity costs.
You've got it. Without scarcity, there'd be no need for economics.
Right. Okay, practical business tool again. Explain break-even point.
The break-even point, BEP, is a crucial concept in business analysis. It identifies the level of sales either in terms of units sold or total revenue at which a company's total costs exactly equal its total revenues.
The point of zero profit, zero loss.
Precisely. Below the break-even point, the firm is making a loss. Above it, it's making a profit. At the BEP, it's just covering all its costs, both fixed and variable.
Why is this so important for managers?
It's vital for decision-making. It helps them understand how much they need to sell just to stay afloat. It's used in pricing decisions, deciding whether to launch a new product, assessing risk, and setting sales targets. It's a fundamental piece of financial planning.
A critical number to know. Okay, broadening out again. Briefly explain international trade.
International trade is simply the exchange of goods and services across national borders. Trade between countries.
Buying and selling between nations.
Yes. It allows countries to consume goods and services they might not be able to produce themselves, or can only produce at a higher cost. It's based on specialization and comparative advantage. The whole field of international economics studies these flows, goods, services, money, investment, and the policies that affect them, like trade agreements, tariffs, exchange rates, and the balance of payments we discussed.
So it's trade across borders and the study of how that works. Next, what is industrial economics?
Industrial economics, sometimes called industrial organization, is a branch of economics that focuses specifically on the structure, conduct, and performance of industries and the firms within them.
So zooming in on how specific industries work, like the car industry or the pharmaceutical industry.
Exactly. It looks at things like market concentration, how many big firms dominate, product differentiation, barriers to entry, pricing strategies used by firms in that industry, like the price skimming or predatory pricing we talked about, advertising, research and development, and the impact of government regulation on that specific industry.
And the source mentioned two elements.
Yes, a descriptive element, gathering facts and information about industries, and an analytical element, using economic theory to analyze business behavior, decision-making, and market outcomes within those industries.
Understanding industries in detail.
Yeah.
Okay, another pricing method. What is going rate pricing?
Going rate pricing is when a firm sets its price primarily based on what its competitors are charging for similar products. They essentially follow the prevailing market price, the going rate.
So less about their own costs and more about matching the competition.
Largely, yes. The source used packaged drinking water as an example. It's common in markets where products are very similar, homogeneous, and price transparency is high.
Why do it?
It's often seen as a way to avoid price wars. If everyone charges roughly the same, it maintains stability. It's simple, and it reflects the collective wisdom of the industry about what price the market will bear, often used for mature, undifferentiated products.
Just match the crowd. Okay, our final question. What are the merits of quota restrictions? Quotas limit imports, exports. What are the claimed benefits?
Right, a quota is a quantitative limit.
Yep.
While seen as a trade barrier, proponents argue they have certain merits. The source lists a few potential effects. The price effect.
Yeah.
By restricting the supply of imports, a quota tends to raise the domestic price of that good. The consumption effect. Higher prices usually lead to lower overall consumption of the good. The balance of payments effect. By directly limiting imports, quotas can help reduce a trade deficit.
Good protection.
Yes, the protective effect. Quotas shield domestic producers from foreign competition by limiting the volume competitors can sell, giving domestic firms a larger share of the market than they might otherwise have.
So influencing price, consumption, trade balance, and protecting local industry are the argued merits.
Exactly. Again, these are the arguments for quotas. And like all protectionist measures, they come with potential costs and inefficiencies as well.
Well, that brings us to the end of our list. That was quite a journey through fundamental economic questions and, importantly, their answers.
It really was. We covered a lot, from the micro-level decisions of firms and consumers right up to the macro-level picture of national income and international trade.
And hopefully, by exploring the answers to these questions, we've given you a much stronger framework for understanding the economic forces shaping our world.
That's the goal. These concepts aren't just academic. They explain so much about why businesses operate the way they do, why governments make certain policies, and how markets function daily.
So as you read the news or make financial decisions, maybe you'll see these ideas: opportunity costs, marginal utility, market structures, GDP playing out.
Which leaves us with a final thought for you to ponder. Considering all these interconnected pieces, production, markets, trade, policy, what single economic question do you believe a society needs to grapple with most consistently to achieve sustainable well-being? Is it about growth, distribution, innovation, sustainability, something else entirely? Something to think about.
A great question to leave us with. Thanks for joining us on the Deep Dive.